On behalf of our team at HBK, I'd like to welcome you to Valuation of Retirement Assets and Executive Compensation with Beth Macetta, Chris Pattison, and Chris Macetta. Our session is scheduled for 1 hour and is being recorded. Please note that all attendees are set up in listen-only mode. If you'd like to submit a question to our panel, please use the question box in the GoToWebinar control bar. If you'd like to receive CPE or CLE credit, you must stay in the session for the full hour and complete the poll questions. A certificate will be sent to you if you answer the poll question requesting one. A copy of the presentation materials is available for download in the handout section of the GoToWebinar control bar. At the end of the session, you'll be provided to complete a survey and provide us with feedback on the presentation. For more information and insights, please visit our evaluation website at hbkvg.com/insights. At this time, I'd like to turn it over to Beth.
Hi, good afternoon, everyone. TGIF, right? So speaking today is going to be myself, Chris Pattison, who's the senior manager in our group, which probably many of you are aware of, and Chris Macetta, who's the senior associate in our group as well. So we probably would want to take your questions at the end of the seminar. So jot them down, put them in the question bar, and then we'll respond to them at the end. So I got the softball questions today. Chris Pattison allowed me to do base compensation, commissions, short-term and long-term compensation. He's got the little hardball questions. So with that, I will send the seminar. So we're talking about executive compensation, and the executives would be people who are working at a large corporation who have various levels of compensation. So we're starting with base salary, and on the first slide, it's base salary, again, is the initial salary paid to an employee. That doesn't include benefits, it doesn't include bonuses, it doesn't include raises, it doesn't include equity awards. So base salary can be paid in many ways and in many forms, either on a monthly, bi-monthly, or weekly basis. Typically, we see executives being paid in salary and not hourly. But I heard something from an attorney probably a few weeks ago that I wanted to bring to your attention, and maybe if there's anyone in the audience who has more insight on this, then they can put a question to the panelists. But it's my understanding that the Rules Committee in Pennsylvania has changed the issue with regard to hourly wages, that starting in January of 2022, that hourly compensation doesn't need to exceed 40 hours a week. And what I mean by that, or what my understanding is currently, is that if people typically work a 50-hour work week or a 60-hour work week historically, that they will no longer be held to that standard. That's my understanding from a discussion with an attorney. If my understanding is incorrect or someone has information that would illuminate my understanding, I would appreciate them to send that to me, or we can talk about it in this discussion. We typically want to understand when base salary increases happen within a year. If we're doing a calculation of someone's disposable income, would want to know when they receive increases, especially if there's a filing date that's partially through the year. We want to make sure that we capture all of the income that's available to that executive. If the executive is also part of a partnership, I just wanted to reiterate that you probably would want to have copies of the distributions that that partner is receiving related to the services that that partner is rendering. Now, if you're doing a calculation partway through the year, there's probably distribution schedules or pay advices that that partner is receiving. At the end of the year, you'll typically get a K-1 for that partner, and included under guaranteed payments, which is on line 4A of the 1065 K-1, you will see guaranteed payments for services. That is akin to that is akin to a salary for a partner within a partnership. So I just wanted to make everyone aware of that. S corporations don't have that information, nor are there guaranteed payments available to S corporation owners and executives. Typical reductions from base salary include union dues. Yes, those are deductible under the statute. Alimony paid to others if there's a previous agreement and there's a signed property settlement agreement that includes an alimony component, and there's a new wife and a new marriage, I would typically deduct the alimony payment currently being paid to another spouse. Mandatory retirement contributions, yes, those are deductible. And typically we would have to get a document that says whether or not those retirement contributions are mandatory or they're voluntary. So when we send document requests and, it's 30 items for income, there are reasons and rationale for us sending that request out. Voluntary retirement contributions, no, we do not deduct those for disposable income. So medical, dental, and vision insurances and the employee's portion of those insurances are not deductible. That's something that the trier of fact or the hearing officer, those are separate calculations. And unreimbursed business expenses, the tax law changed a few years ago. There's no longer a Form 2106, and you won't see them under Schedule A under itemized miscellaneous deductions for business expenses. But if those business expenses are required in the normal operation of the business, say for my professional license, it's a requirement. I get reimbursed from HBK, but some people don't get reimbursed for that. So I would think that that would be an allowable deduction for the calculation of disposable income. Just a practice note with regard to voluntary retirement contributions and medical, dental, and vision insurances. The voluntary retirement contributions are a deduction for federal taxes. It is not a deduction for Medicare or state taxes. So we typically use Medicare as the amount to be included for disposable income. But remember that Medicare is also reduced by the employee's portion of medical, dental, and vision insurances and their proportion of those insurances. So you may want to get the last year's pay stub to figure out what those benefits are and what the employee contributions are. And then you would want to beef up the income to include those. And then the master or the hearing officer or the trier of fact will make the calculation. Next slide. The next part I wanted to talk about would be short-term incentive compensation. And as the slide says, short-term incentive compensations are intended to compensate executives for achieving short-term goals. And some forms of incentive compensation for a short-term period would include bonuses, commissions, and profit-sharing plans. With regard to these short-term incentive compensation pieces, they can be formula-driven. It could be based upon the executive's performance. It could be based on the executive's and his department's performance. It could be based upon the entire company performance. So you may want to have an understanding of what the formula is and whether or not that executive is meeting or exceeding those performance goals. So I've seen it in many instances where executives either meet or exceed those goals, and the bonuses can be calculated over 100% of what the estimated bonuses are. So again, when we're sending out a discovery request and we're asking for documentation or evidence of bonuses, that's what we're looking for to determine whether or not they are meeting, exceeding, or not meeting or exceeding their goals. We want to know when the bonus was earned, and that therefore it would determine the marital and non-marital components of the bonus. So Sometimes bonuses aren't awarded until the next year, say February or March of the next year for the prior year. So do the parties get separated in the prior year in September? That bonus typically, it depends on what side you're on. It's for the payor spouse, it's better for it to be an income item, and for the payee spouse, it's better to be an asset. So we typically ask when that bonus was earned versus when it was paid. Also, you want to make sure if that bonus was paid prior to the party separation, that if you're calculating disposable income going forward, that bonus has already been paid. It's already in a marital account. The parties have probably already split that bonus up. So you don't want to include it going forward until you're doing a calculation for the next year. You also want to make sure that that bonus has stayed in the marital account and has not been, I don't want to say secreted away, but put into a separate account or a segregated account. You want it to be included as marital asset. You also want to know if those bonuses are recurring or non-recurring. Is it an anomaly that someone got a $100,000 bonus? Is it COVID related? The company had extra income and therefore it wanted to share the bonuses with the executives of the firm. So you want to understand if it's a one-time bonus or it's a reoccurring bonus. I have an example, and I have a client currently who gets a base salary between $300,000 and $400,000. His bonuses are paid periodically by the majority shareholder in the company. He's a minority shareholder in the company. And his bonuses are 2 to 3 times what his base salary is. So the trier of fact has the obligation to do a calculation. But typically, if I have another expert on the other side, I don't want to jackpot my client or their client and put them in a cash flow deficit and include 100% of those bonuses in a calculation and therefore pay either alimony or child support month to month when they don't get those bonuses and they can't dictate what those bonuses are and they're not sure when the bonuses will be paid. So if the other expert is agreeable and the parties are agreeable, we would pay a alimony or support award based on a base compensation and then come up with a formula that if and when a bonus is paid, that on an after-tax basis, that person shares in that bonus pool. So that's why it's good to have a good relationship between the other expert and the other attorney on this case, and it helps your client out in the long run. So that would be helpful in that case. The next component is commissions. We need to know how are commissions computed. Some of the metrics for commissions include revenues, profits, customer sales, overall company sales, overall goals of that individual. Commissions can be paid monthly. If you have a financial advisor, they're typically paid monthly. They can be paid quarterly, or they can be paid annually. And again, you have to be cognizant of that when you're computing disposable income and when you're computing assets for equitable distribution purposes. The documents that we typically get regarding commissions would be commission statements. You want to also be aware of when somebody filed for either support or a modification of support. Were the individuals or the executives' commissions extremely high in the first quarter and then they peter off in the last 3 quarters? Are there spikes in the commissions? Do we want to normalize for those commissions? And what I mean by normalize is kind of smooth that commission amount out. Then we also have profit sharing contributions. And the questions that we typically ask for the profit sharing contributions is the executive vested in those profit sharing contributions immediately? If he doesn't vest, then they're not available for support. The other thing we want to know, does he have access to the funds? Are those funds available for those to be distributed in support? If they're not available and they're not vested yet, then they can't be included for disposable income. So again, if we would send out a document request and we're asking for the profit sharing plan description, we would need to know that whether or not or when the executive gets vested, and when and if those funds are available. Next slide. So the previous three, the bonuses, the commissions, and the profit sharing, are forms of short-term compensation. Now I wanted to get into the long-term incentive compensation. And again, as the slide says, are intended to compensate executives for achieving the company's long-term goals and their own individual long-term goals. And sometimes they're golden handcuffs to keep an executive at the company that he's working for a long period of time. Sorry. Because if they are terminated for any reason or they quit for any reason, a lot of these long-term incentive compensation elements are not available. So they leave a lot of money on the table when they leave or they're terminated for any reason. Next slide. For the first type of long-term incentive compensation, I want to talk about stock options. Now, a stock option is a privilege sold by the company to the executive that gives that executive the right, but not the obligation, to buy the stock of the company. The important dates to remember with regard to valuation of stock options is the vesting period. Typically, in a lot of cases, we see that stock options vest after 1 year of service and after the date of the grant. But they may have an expiration period of 10 years. So you have to be cognizant of A, the vesting, and B, the expiration date, and then finally C, what the date of the grant was. We utilize the date of the grant in order to determine the marital or non-marital value of the stock option. Primary components of a stock option, and when we're valuing them to be distributed, an equitable distribution, include the current fair market value of the stock, the strike price of the stock, the time until expiration. Again, as I said, I've seen them out as long as 10 years. There could be even more. The volatility of the stock. And what I mean by that is the ups and downs of the value of the stock. Now, typically, you'll see volatility on a publicly traded stock. If you have an ownership interest or your executive has an ownership interest in a closely held stock, you may be able to liken it to a publicly traded stock in that same type of industry, and that would be something that could be reliable. You would need the risk-free rate of return, and you would also need to know the dividends and whether or not those stocks are paying dividends. There are two primary types of stock options: the incentive stock option and the non-qualified stock option. I typically see non-qualified stock options. And when a executive receives stock options, he has to accept the grant. There will be a grant document. He will be granted shares, or she will be granted shares. And there is a plan document that describes the compensation or the option or the equity award. And then every grant, there will be an acceptance award of the number of shares of stock options to be received. Now, what you will see on an executive's pay stub would be the difference, and this is upon exercise. And just so I back up 1 minute. So the employee doesn't recognize any income on his W-2 or in his pay stub until he exercises that option. So once that option is exercised, the difference between the fair market value of the shares at the date of exercise minus the strike price, which is what he is paying for the ownership interest in those shares, the differential is included in the pay stub and it's included in the W-2. Now, if you have a W-2 that has a V, I believe in box 14 or 12, I don't remember the box number, that means that stock options have been exercised in that year. So that would be interesting to know that you have a W-2 that has a V in it. Then you know, oh, okay, I'm getting a W-2. It has stock options that were exercised. Do I want to include this income from this exercise as income available for support, or do I want to include it as an asset? So it's important to understand those codes in the boxes on the W-2. Now, there are cashless exercises, and what I mean by that is that the executive, A, doesn't want to pay for the stock out of his pocket, and B, the taxes on the exercise, he doesn't want to pay out of his pocket. So, for example, if the executive has 1,000 shares of stock options that he would like to exercise, he has to first pay for those shares at the strike price, and they may withhold a certain number of shares in order to cover the purchase for that executive of those stock options. And secondarily, he doesn't want to pay the taxes on that exercise of the stock as well. So what happens with that is they withhold even more shares. So what happens is those 1,000 shares are reduced for the purchase of the shares and also reduced for the taxes. And just a practice note, when an executive exercises shares, and he's in a large corporation, say Mellon or PNC Bank or another large corporation, they usually have a standard withholding amount of federal income taxes. So don't assume that the taxes that are withheld are necessarily indicative of that executive's tax rate. We always recompute the taxes to make sure that that executive and the net amount is actually the correct amount, because it's obviously harder to go back and ask for money from somebody after a distribution than it is to do the taxes at the front end. So the pricing methods for stock options for equitable distribution, there are two basic pricing methods. There's the intrinsic valuation method. The intrinsic valuation method is the current fair market value of a stock minus the exercise price, minus the taxes, and that would be the value that you would put forth on your marital asset and liability summary. Typically, I see that in cases where there are significant assets and say the executive wants his shares, he wants to take the risk of that stock going up into the future. So we have to assign a value to it for equitable distribution. So that goes on the executive side of the ledger. And then there are other assets to offset that asset valuation on the executive side. That's typically when we would do it on an intrinsic value method. Now, the Black-Scholes method is a more comprehensive method of valuing it. It takes into consider the risk of that stock. It takes into consideration dividends paid on that stock. It takes into consideration the volatility of that stock. And there are calculators that we use online that you plug in all of that information to determine what the value would be. And again, that methodology for valuing the stock would also say, okay, the executive has $200,000 worth of stock. He wants that on his side of the ledger, and there are equivalent assets on the other side of the ledger that are going to the ex-spouse. There are two types of options, the American option and the European option. The European option is less common and can only be redeemed at the expiration of the option. So that's an interesting tidbit. And then we have two methods of distribution. There's the deferred distribution method, which means that there's probably not enough money or not enough assets to divide. And so therefore, the person who is receiving the stock or the value of the stock will pay it out at some deferred date. So say husband and wife, it's not a 50-50 distribution, it's a 55-45 distribution. Husband would pay to wife at the exercise. And that exercise shouldn't be withheld for any reason, and it shouldn't be withheld unduly. But wife would get 55% of the after-tax value of the exercise price, the strike price, and the taxes at some later date. Now, the immediate offset is the value. If you're putting it on the spreadsheet, you know that you have other assets to offset it. So there's two types of distribution, and there's basically two methods to value stock options. Next slide. Michelle, we've got a polling question, so. So if you responded to the polling question, the next type of a long-term equity award would be a restricted stock unit. Can you move the slide, Michelle? Thank you. As the slide says, RSUs are a form of incentive compensation issued to an employee or an executive in the form of company shares. These have a vesting cycle. They can be paid out in the form of cash. They can be paid out in the form of stock. There is typically a distribution schedule, and on large companies, they usually have an investment company that manages all the equity awards. So I just had one this morning that I was looking at. So PNC typically uses Fidelity. It incorporates the stock options. It includes the RSUs. It includes the RSAs and performance shares. So typically when you're getting documentation on equity awards from a highly compensated individual, you would need to know the brokerage firm or the investment company that basically maintains the records of all of that information. So a restricted stock represents a promise made to an employee by an employer to grant a given number of shares of the company's stock to the employee. Now, once they vest, and typically I see them vest either over a vesting schedule, and typically it's 1 to 3 years, or they can cliff vest. So I've looked at 2 different PNC plans in the past 2 days, and one has a cliff vest and the other one has a vesting schedule. So it's kind of interesting that certain shares vest over a cliff and some are on a vesting schedule. What we're interested in to determine the value for equitable distribution are these RSUs granted for past performance, or are they granted for future performance? And typically we would need to see what the RSU plan document says. Some of the documents are more specific than others. Some of them don't give you any indication if it's for past performance or future performance. Next slide. I also wanted to tell you about RSUs before I move forward to restricted stock awards, is that differently than a stock option that the executive has to pay a strike price for, you don't have to pay for those RSUs. Those come to you free. Not free. I mean, you work for them, but you don't have to pay anything out of your pocket in order to get them. Now, RSUs also, when they are vested and they're distributed, they're typically distributed through that brokerage account that I referred to. And typically those are done in a cashless option as well. And what happens with that is the RSUs go into the pay stub. You'll see them on the pay stub. You'll see them on the W-2. But they will typically withhold enough shares in order to cover the taxes. And much like the stock option for the bigger companies, they have a standard tax rate because not everybody has the same effective tax rate. So you have to make sure that you recalculate the taxes to determine what the net after-tax value of the RSUs are. On this slide, we're talking about restricted stock awards. The restricted stock award is a grant of company stock, which they receive the rights to stock, which are restricted until they vest. The difference between an RSU and an RSA is that the RSA you can vote on company issues. I believe that is next slide. Another type of equity award that we see less frequently, but we've seen it multiple times, are performance share awards. And as they say, we don't really have to look to see if these were granted for past performance or future performance. They are definitely tied to company metrics. It could be tied to individual performance, department or division-wide performance, or the entire company performance. And sometimes after the performance period, and they could be long periods of time, it's not 1 year, it's typically 3 years I've seen, and I've also seen 5 years. They can either get 0 at the end if they don't meet the performance criteria. They may get some percentage of the performance. So say the company expected to generate another $10 million in that division for that 5-year period. And say they only made it to, 80%. They may pay out 80% of the performance shares, or they may pay out 0. So these are very hard, even though they're granted during marriage. If the performance period is after separation, or partly after separation and partly before separation, we probably would attach a coverture fraction to those PSAs, and that at some time in the future when they're paid out, it would be an asset for equitable distribution, or it would be income available for support. So we always have to do that fine dance and that balance between the two calculations. Next slide, Michelle. Sometimes there is compensation in the form of phantom stock. There's not actually a stock certificate issued, but there is a promise. There's usually an agreement between the executive and the employer, and they may not get anything until an event happens. Now, the event could be a sale. The event could be a majority interest in the company being transferred. It could be some kind of an equity position being taken over. And there could be some kind of sharing arrangement if there has been any kind of sale or a transfer of the business interest. You never will see a stock, you won't see a stock certificate, but you will see an agreement. So that's important to ask for that. These are very infrequent. I haven't seen a lot of these in my career, probably 1 or 2. Next slide. Another form of compensation is the employee stock ownership plan that allows the employee to receive ownership interest in the company. The good thing about this for us valuation people is that on an annual basis, a valuation of the company has to be done. The shares have to be valued at that date, and then the shares are distributed to the employees. I've come across a few of these in my lifetime with regard to equitable distribution. I don't see them in the pay stub at all. And I don't have a next slide, but I wanted to talk about one final type of equity award. But it's really not an equity award per se. It is the right to purchase at a discount the employee stock purchase. So typically on these larger companies, say the fair market value of the stock is $150 a share. They may allow the executive or the employee to purchase the share at a 10% discount. That 10% discount will be included in the employee's W-2 and will be included in the employee's pay stub. So to the extent that it's for a purchase of shares post-separation, then we want to include the income. If it's a residual payment for prior obligations during the party's marriage, you would want to exclude it for the calculation of disposable income. Chris Macetta, our senior associate, will be taking over and describe the documents that we would need in order to determine bonuses, short-term incentives, and long-term incentives. Go ahead, Chris. And next slide.
Thank you.
Sorry, go back one slide. I apologize. Michelle, do you want to go back a slide so Chris can go through the documents? Okay, go ahead.
So as Beth said, my name is Chris Macetta. I'm going to talk about the documents we would usually request in order to summarize the client's base compensation, short-term compensation, and long-term incentive compensation. So the first documents we usually request would be the client's pay stubs and their W-2s. W-2s and pay stubs are necessary to determine the client's total compensation. We also use them to see if there are any deductions or additional compensation items outside of wages. And we would also use the W-2 to match the client's wages to the wages they report on their personal tax returns. So often W-2s don't provide the entire picture of the client's total compensation information. So we use the breakdown of the client's pay stub in order to see all other forms of income, any type of perquisites, or any other deductible items for purposes of disposable income calculations. So pay stubs also reflect information regarding non-recurring or long-term incentive income items. We would also need to know about these in order to determine if they are marital or non-marital from a litigation perspective. So the period we request is generally the last 2 years of W-2s and the last 2 year-end pay stubs. We also usually request the most current year-to-date pay stub from clients. We do this in order to ensure that there are no significant differences in the client's wages from different periods. However, if we are made aware of any significant changes, we would request additional years of information in order to establish the entire historical picture. So in addition to pay stubs and W-2s, we would request to see if the client has any employment contracts or any compensation summaries provided by their employer. We request these because they can usually further detail how a client's compensation is determined, and as well as any additional forms of compensation or any perquisites the client is entitled to that may not yet be reflected on their pay stubs or W-2s. So outside of those documents for the client's direct base wages, we would also request any 1099s, any K-1s, or any investment account year-end summaries to determine if the client has any supplemental income outside of wages. These could come in the forms of interest, dividends, capital gains, distributions, or any non-employee wages from other sources. So those are the documents we would usually ask for in pretty much every case. Some more that we would include on a case-by-case basis would be letters or correspondence regarding any increase in the client's base salary, any annual bonus calculations produced by the client's employer. If the client is commission-based, we would request commission sheets or internal commission calculations, which would usually be payable on a monthly or quarterly basis. We would also ask for any expense reports or any documentation regarding expenses paid for on the client's behalf by his or her employer. And we would also ask for documents specifically regarding perquisites if applicable. These documents could include any leases for any apartments or houses paid for an employer on the client's behalf, any documents provided by the employer regarding any cost of living adjustments, any declaration pages for insurance policies for an employer-provided vehicle, the make, model, and year for any employer-provided vehicle, and for any employer-paid life insurance policies, as well as any evidence regarding any premiums paid for on the client's behalf by the employer. Together, these items give us the best picture to determine the client's total compensation and can help us in determining which items are includable for any potential disposable income calculation. Switching gears, For the client's long-term incentive compensation, which, as Beth mentioned, could be stock options, restricted stock, all the other ones she listed. Some of the additional documents we would ask for, including the ones that I've already mentioned, more so information we would ask for would be the grant date, which determines when the restricted shares are awarded to the client. The shares granted, which would be the number of shares the client receives on the grant date. The vesting schedule for the client's restricted shares. The vesting schedule would also outline when the shares will vest and will be eligibly sold by the client, which will usually vest in tranches around the initial grant date. We would also ask for the expiration date, as Beth already mentioned, and we would also ask for the client's date of marriage and date of separation. These dates would dictate the marital and non-marital portions of the restricted stock unit. The dates apply to the grant date of the stock and not the vesting date, and the stock is considered marital based on when the stock is earned, not vested. Some additional documents we would ask for in specific cases. For stock options, we would ask for the employee agreement, any individual pay advices, which would reflect the strike price, the excise price, the grant dates, the vesting dates, and the expiration dates. And then any agreements, letters, or correspondence reflecting the grant, award, or issuance of stock options if the summary plan or individual plan documents are not provided. For RSUs or RSAs, we would ask for investment statements from the brokerage houses, as Beth mentioned. These reflect all vested and unvested RSUs and RSAs in a client's portfolio. Next slide.
Good afternoon, everyone. My name is Chris Pattison, and I'm going to talk to you a little bit about one of the more common forms of incentive compensation, which is in the form of retirement benefits. Most full-time employees are offered some sort of 401k or cash balance plan, pension benefit, or other similar type of deferred compensation. These types of plans typically give an employee some form of security in knowing that they will have income available other than Social Security benefits when they eventually retire from a company. Next slide. So what is deferred compensation? Deferred compensation is a portion of an employee's compensation that is set aside to be paid at a later date. The taxes on this income are also typically paid out at a later date, which can provide favorable tax treatment in the event that the person will be in a lower tax bracket once they do retire. There are two subgroups of deferred compensation. The first is qualified plans, and the second is non-qualified plans. Qualified plans are governed by the Employee Retirement Income Security Act, also known as ERISA. Most common forms of qualified plans are 401ks, 403bs, cash balance plans, and pension plans. These benefits are typically offered to all employees that qualify to participate in the plan. There is a limit, however, on to which the contributions can be made to qualified plans within a year. They're typically capped. Funds are set aside in a separate account for the employee, and statements for each employer are usually available. The next slide, please. Non-qualifying plans are not offered to all employees. Most common types that I've encountered are supplemental executive retirement plans, also known as SERPs, and deferred savings plans. There are no limits on these types of plans, so they are beneficial to well-compensated executive employees that may have already reached their limit in a qualified plan. These funds are not specifically set aside for an employee and typically remain a component of the employer's equity, the company's equity. So in the event the company goes bankrupt, they're not protected from creditors, which adds a level of risk. So if we have a non-qualified pension plan and a qualified pension plan, and we assume all other things are equal, just based on the level of risk, the qualified pension plan would actually have a higher value. Next slide, please. So what are the most common types of retirement plans that we're asked to value? There are defined contribution plans and defined benefit plans. Defined contribution plans are typically funded by employee contribution and usually a matching contribution made by the employer based upon a percentage of the employee's contribution or a percentage of their base salary. Contributions to defined contribution plans are typically tax deferred, but withdrawals are taxable. Defined contribution plans have account statements, which would reflect the account balance, the account activity, including any kind of growth that would be on the account. These plans typically have restrictions in place regarding when withdrawals can be taken based upon a certain age in order to avoid tax penalties. That age is 59 and a half. In the case of a 401k, there may be hardship withdrawals or loans taken. There are certain qualifications that have to be met in order for a hardship withdrawal to be taken. In addition, to avoid a penalty, a 10% penalty from the IRS. Loans that are typically taken need to be paid back within a certain period of time. Most times it's 5 years. So we have a lot of cases in family law where we need to determine the marital and the non-marital components of the defined contribution plan. So how do we value these plans for Pennsylvania divorce purposes? These plans are subject to specific guidelines that are set forth in sections 3501 and 3502 of the Pennsylvania Divorce Code. So the first thing that we need to do is determine the specific dates necessary to value these plans. As Chris Macetta had alluded to earlier, and similar to the same dates that we would look at when we're valuing short-term or long-term restricted shares or stock options, we need to know the date of marriage and the date of separation. And it's in order for us to determine if there are any non-marital components and what is the marital component of the plan. Generally speaking, the contributions made during the marriage and the earnings generated on those contributions, both during the marriage and after separation, are marital. So if an account is solely funded during the marriage and it increases after the parties separate, the entire account remains marital. Contributions made after the parties separate, as well as the earnings generated by those contributions after separation, are also marital. So what happens if an account has a premarital balance? Well, the premarital component would be non-marital as of the date of marriage. However, the growth on the account during the marriage is considered marital. Under this situation, we're asked to measure what's called an increase in value from the date of marriage to the date of separation or the current date, whichever the lesser of. So to give you an example, if there's a $100,000 balance in the account as of the date of marriage and no contributions are made during the marriage, but the account then grows through various earnings to $150,000 when the parties separate, the $50,000 would represent the marital component, and the $100,000 balance would be the non-marital component. And if we say that same scenario, but let's say after separation, from the date of separation to the current date, the value then decreases, to $125,000. Then the marital component would only be the $25,000. We're looking at whatever the lesser of is. So essentially, we're being asked to carve out the non-marital component when valuing these plans. We have both marital, and when we have both marital and non-marital components, and there's growth that occurs post-separation, we need to allocate those earnings between both the non-marital and the marital components based upon each category's percentage of the overall account balance. Other things that we want to look at would be loan repayments. What is the timing and the purpose of the loan? Were they used for marital purposes or non-marital purposes? Because we're trying to determine, how it impacts each of the components of the account that we're looking for. Once we've arrived at determining the marital and the non-marital components, we're typically asked to prepare a tax analysis regarding the account. And there's two methods that we typically look at: the immediate tax reduction method and the projected tax reduction method. Under the immediate tax reduction method, we take the entire balance of the account and we assume that it's going to be withdrawn as a lump sum, in a lump sum currently. That's typically going to result in a lot higher tax rate and most likely a penalty of 10%. And that's not usually a method that we use, because a person that retires isn't most likely going to take out the entire account balance in one lump sum. He or she is going to take it out over a period of time during their retirement. So the projected tax reduction method, although it is not exact because we don't necessarily know what the tax rates will be during the retirement, especially we don't know what the tax rates will be next year. But we think it seems more reasonable because it's typically shows how a person would withdraw their funds over time. In preparing the projected tax reduction method, we grow the account balance from the current date through the date of the person's retirement. Then we take that lump sum and we annuitize it into equal annual amounts over the person's life expectancy. Then we tax impact each year to determine what an effective tax rate would be. Next slide, please. The second common type of retirement plans are known as defined benefit plans. These represent pension plans or cash balance plans. Cash balance plans are solely funded by the employer and are similar to defined contributions, where you receive account statements which reflect employee contribution credits and interest credits. Pension plans are also employer-sponsored plans that are funded solely by the employer, and the payout is typically based upon some sort of a formula, whether it be years of service, average salary. There's usually a multiplier and some sort of combination of those factors. Employees of these plans usually can receive their money, receive payment in a lump sum or a monthly annuity, which would be available upon a predetermined age. The age can vary based upon the years of service in a company. Pension benefits are taxed as ordinary income in the year they are paid, or in the year they are paid. Depending upon the plan, there can be multiple options to choose from regarding the annuity, whether it's a lifetime benefit. In other words, the person's going to receive a monthly benefit from retirement through the remainder of their life expectancy. There can be survivor benefits. A survivor benefit would be where the designated beneficiary would begin to receive some sort of a benefit once the pension holder dies. The benefit can vary, and what typically happens with the survivor benefit, the pension holder elects to take less money up front in order for their survivor to get some percentage of the benefit later on, whether it's 50%, 75%, or even 100% of the same benefit. One fact that exists is once the benefit is in pay status, the form of the benefit might not be able to be changed. And it's very rare that they actually are able to be changed. Information determining, the payment options, calculation of benefits, normal retirement age is usually contained in the summary plan description. So how do we value a pension for divorce purposes? Let's go to the next slide. There are two methods that we primarily use, the immediate offset method, which Beth had spoke about before, and the deferred distribution method. Again, the immediate offset method can only be used if the marital estate has sufficient assets, so one spouse can keep the entire pension and the other spouse can be compensated with assets of equal value. So under the immediate offset method, we're just trying to determine what a lump sum present value of those future benefits would be. The calculation is typically based upon the current monthly accrued benefit, the life expectancy of the individual receiving the payment, and an interest factor. And so we need to determine when that benefit is earned, because once we do have a lump sum amount as of the current date, we need to apply what Beth had referred to as the coverture fraction. And the coverture fraction is to determine the marital portion is simply it's based upon the years of service earned during the marriage divided by the total years of service that the pension is earned. If, again, there aren't enough assets to offset, we use what's called the deferred distribution method, and typically the monthly pension benefit in the future gets split between the parties by way of some qualified domestic relations order, or also known as a QDRO. We still apply the coverture fraction to that benefit. So in other words, if it's a $1,000 benefit, let's say that 50% is earned during the marriage, it's that $500 portion that's then split between the parties. The other $500 portion that's non-marital remains with the pension holder. Let's go to the next slide. There are also a number of unique and pension plans that have certain nuances, like military pensions. There are also different municipal and city pensions where there's a number of different nuances, such as COLA adjustments, frozen benefits. There are actually, with regard to a lot of fire and police, there are people that don't actually pay into Social Security. So a portion of their pension may actually be attributable to what a Social Security benefit is. And in that situation, we were asked to carve out what that would be based upon, there's case law out there called Kornbleth versus Kornbleth. And so we have to take that into consideration. So there are many factors and potential issues to consider when valuing defined contribution plans and defined benefit plans. In the event you need some assistance in preparing the necessary calculations, we would be glad to help. Chris Macetta is now going to talk about some of the documents needed. You could forward two slides. One more slide, please. Thank you.
Okay, so in talking about the documents we would need to value a client's retirement assets, the asset is a 401k or an IRA. The client should provide the company's summary plan description and their retirement account statements, whether they be monthly, quarterly, or yearly. We would accept yearly statements, but we prefer quarterly or monthly because it's easier to track contributions and distributions out of the accounts with the smaller time period for each statement. So we would generally ask for the statement closest to the date of separation, and then all statements beyond that until the most recent statement to the current date. If the 401k or the IRA has a premarital component, the client must also provide a statement closest to the date of the marriage. In addition to those, we would also need any documents reflecting loans or loan repayments against the 401k or IRA, if that applies in any particular case. If the asset's a pension, the client should provide the summary plan description for the pension plan, as well as any calculation of benefits provided by the company. We would also ask for any payout options or any payout options that have already been selected, or we would also need to know if the pension is currently in pay status. For both pensions and for 401ks and IRAs, We would also require the client's most recent Social Security statement, as well as the client's life expectancy data. We actually usually do the research for the client's life expectancy data, but we would appreciate it if you guys would send it anyway. So we use these items to determine the client's tax calculation, which would then be applied to the total value of the asset to determine the after-tax value, which is then annuitized over the individual's life expectancy. Additionally, if the asset is already in pay status, the client's personal tax return would also be required to determine the tax impacts of the distributions already received. So with that, to go to the next slide, and I'll turn it back over to Beth to round us out.
You know, we're probably out of time here. I wanted to talk a little bit about other forms of compensation and perquisites, which are, you know, important in some of these calculations for executive compensation. As we're running out of time, I don't think we can get to these slides. On another note, if you have any burning questions or questions for us in general with regard to these other forms of compensation, perquisites, or any other types of compensation or valuation of any assets, I'm going to refer you to our CVs, which are attached to the materials. And our email addresses are included in there, so you can go ahead and respond to us. And on a final note, I did want to talk about at some later date, probably about distributed and undistributed income related to business owners who have ownership interests in C corporations, S corporations, and also Schedule Cs and partnerships, and talk about the double dip, talk about retained earnings, talk about some other things. So we're planning on doing another seminar, so look out for that. We appreciate your time and attention. Sorry, we ran a couple minutes over. Remember, if you have any follow-up questions or any concerns, go ahead and send questions to our email addresses. They're attached to the webinar and the materials. And thanks for your attention, and have a great rest of your day. Thank you very much.